Good evening, boss.
Good evening. So the purpose of this meeting is to discuss about the financial performance. So for this year, I would like to give more dividend to the shareholders, but seems like our profit is a bit low, so I think all of you should start to implement credit accounting and earning management.
Alright, understood. I'll let everyone in my department know.
Assets, liabilities, own equity.
Attention all, the company intends to implement creative accounting and earnings management for the financial reporting. So please amend accordingly and make sure to hand in a nicer financial report to me.
What? Seriously? I don't know how to do it.
No worries, we got your back.
Do you know what creative means and why it is implemented? And what are the methods to implement it?
Yes, let me and Lemmin explain it to you.
As early as 1994, creative accounting is being defined as management practices that influence reported figures and provide false economic advantages to the organization that may be detrimental in the long term. With the concept of creative accounting become more popular in recent years, its definition also become more comprehensive as well. Creative accounting generally can be defined as accounting practices that abide by the required accounting standards, law, and regulations, but capitalize on loopholes in accounting standards to forcefully portray a better financial image of an organization. Well, for earning management, there are also many definitions of earning management by different researchers in the financial literature. Generally, it can be defined as an intentional use of accounting techniques motivated by opportunistic and informative objective to present attractive financial statements different from the actual results. Although creative accounting and earning management is different in nature and have their own definition, they are nevertheless connected and related to each other to a certain extent depending on the varying circumstances and economic climate.
Through the knowledge of the accounting rules and the flexibility in choosing accounting principles and standards and exploiting the existing gaps, it creates opportunities for the emergence of creative accounting and earnings management, where the discretion offered to management is utilized to influence the reported results. Therefore, why do companies exercise creative accounting and earning management? Firstly, it is due to speculative motivation, which means managers exercise creative accounting and earnings management for their own personal interest, either to gain personal benefits or to achieve internal financial goals set by the company. There are two types of self-interest motives. First is non-financial interest, where managers want to prove their capability and usefulness so that they can improve their career position in the company. Another type is financial interest. Compensation and bonus plans, which are tied to the company's performance, provide a strong motive for managers to manage earnings in order to increase their monetary rewards. The next reason is pressure from management. The management will pressure the accountants to manipulate financial information so that the financial reports show a positive and good performance of the company even though it is not the actual case. By doing this, the company can have better and easier access to financing opportunities such as having a good credit rating score and successfully getting a loan from the bank. Another motive is to reduce the company's tax burdens. The company will reduce their reported income to near zero so that they can pay a much lower tax amount. The last reason is pressure from external parties. Managers, especially for listed companies, want their financial statements to look good to stakeholders by meeting financial goals and investors' expectations. If a company fails to meet earning targets or projections, investors lose confidence and the share price plummets. Alternatively, if financial statements report steady profits, the company remains in a strong position to attract investment, thus driving the share price up. Given these implications, managers are strongly incentivized to engage in creative accounting activities so that they can positively influence the company's value and reputation as well as promote the image of steady gains.
So now I will proceed to common methods in creative accounting and earnings management. First, improper revenue recognition is the most common kind of creative accounting that is practiced in Malaysia. The accounting procedure known as revenue recognition enables business to record sales even before they have actually provided the items or carried out the service in question, and is open to being used unethically. Second method is Channel stuffing, which is an illustration of improper revenue recognition. Channel stuffing is a method that the business use in order to inflate their income by shipping more products to their distributors or retailers than the end users in order to fulfill revenue targets. This may result in a temporary gain in revenue. However, it may also create future problems for the company. For example, the company will need to make an adjustment to its revenue in the event that the products are returned back to the company. Moving on, the third one is depreciation. Reassessment, the useful life of fixed assets and residual value is considered a form of creative accounting since it's a method to manipulate the company's financial statements in order to make the business have better performance. For instance, following the usable life estimate of the assets, the depreciation will be spread out over a longer period of time, which will result in an overstatement of the value of the company's assets in the balance sheet. Under earning management, the first is the cookie jar reserve. A cookie jar reserve is an accounting term that refers to a reserve account created by a company to manage its earnings. This technique is used in earning management where a company can draw from the reserve account in future periods to adjust its earnings. The main goal is to make the earnings appear more consistent over time, which can help to maintain investor confidence and also avoid the negative reaction to fluctuations in earnings. Second one is big buff strategy. It's a method that used by companies to manage their earnings, involving the intentional taking of large write-offs of charges in one period to significantly reduce reported earnings. A company that is experiencing financial difficulties may use the big buff strategy to reset earning expectations and create a better financial outlook. This creates a lower earnings baseline for future periods, making it easier to meet or exceed earnings expectations. In addition, earnings management use operational and non-operating earnings. Operating earnings are a company's core business income. This covers sales revenue, cost of goods sold, operating expenses, and depreciation. However, non-operating earnings derive from non-core business activity. This includes asset sales, investment income, and other one-time events. Earnings management can alter operating and non-operating earnings. For example, earnings management may use non-operating earnings to smooth earnings or raise reported income. Besides, delaying revenue recognition or altering expense accruals might overstate operating earnings. That is all of the methods. Thank you.
Ah, I see. Then do you guys know of any examples or incidents of the creative accounting and earning management?
That's for sure. Let me explain it to you.
Ramaninggalaju is the owner of Siam Computer Service Limited, which is the Indian IT company. What they did, the Samyam's manager falsified Samyam's revenue, profit margin, and profit statements year after year from 2003 until 2008 by overstating the company's financials. There were also non-existence of bank loans and cash that Samyam's claimed to its own. Satyam also underreported liability on its balance sheet to meet analysts' expectations over the accounting. Mr. Raju, the owner of the company, also create fake customers' profile and generate invoice under the name of the fake customers.
Wow, it's interesting to know that, but are there any repercussions of doing this earnings management and creative accounting?
Shh. Although there are some implementations to reduce the uses of creative accounting.
Roles of management in managing creative accounting and earnings management. In the BOD part, number 1, responsible for overseeing financial information are accurate and reliable. Number 2, develops guidelines that discourage unethical practice and promote transparency. Number 3, oversee companies' risk assessment and establishing good controls. Number 4, communicates with shareholders and stakeholders to provide accurate information on company performance. Number 5, rewarding integrity work. For audit committee, they can number 1, monitor the accuracy and compliance of financial statement reporting. Number 2, selecting independent auditors for unbiased examination of financial statement. Number 3, helps to identify and manage risks relating to creative accounting. Next, we have internal auditors. Number 1, controls evaluation, where they need to review controls to ensure effectiveness and prevent fraudulent practice. Number 2, monitor compliancy of accounting standards, regulation, and company policies. Number 3, suggesting improvement to enhance transparency and accuracy in financial reporting. Number 4, providing training to promote ethical behavior and educate employees on financial reporting requirements. We move on to auditors. Number 1, to maintain a professional skepticism when approaching audit to detect potential misstatements. Number 2, maintain good communication with management and audit committee. Number 3, performing testing and verification by data sampling to identify potential instances of creative accounting. Number 4, must provide independent opinion on accuracy and fairness of client financial statement.
Great! I finally understand. You guys have helped me very much. Thank you.
It's our pleasure.